Good morning. Welcome to the NEPC webinar on Brexit, which we've subtitled A Vote for Volatility. We're so thankful to have you with us today. There have been, at least on my calendar, 5 or 6 events every day from different folks around the world, really reacting to an unexpected outcome last Thursday with the vote by Britons to leave the EU. We're so thankful to be able to bring to you today 2 managers to share their views. One thing in looking at all the Brexit webinars and commentary, of course we're going to get similar views, similar house views from different organizations. So we thought one way we could differentiate a bit is by really bringing in 2 different organizations, and as you know, as we announced this webinar yesterday and the vote happened on Thursday with results known early Friday morning, this was a bit of a scramble, and we're so pleased to have Nanette Jacobson from Wellington to speak to their views and her views about what Brexit means, and Laura Sarlo from Loomis. Such a great opportunity to get together here, and the plan for this webinar is I'm going to speak briefly about, and I'm sorry, this is Chris Levell at the top of the page. I'm going to be speaking briefly about some of the facts. We have some interesting survey results going into the Brexit vote. Then we're going to be following the order on this page with thoughts from the managers. And then Phil Nelson is also going to be, from NEPC, is going to be conducting a poll that we're going to have first up front, and also going to be receiving questions. So for those of you that are participating in the webinar on your computer, you should be able to see a question area, and the questions that you ask there, we'll try to get to as many of them as we can at the end of the session today. We'd also like to start up front with a poll. So before we tell you the thoughts of the managers here, we thought it might be interesting to ask you first and get some participation as to what you consider your actions to be as a result of the leave vote. We've given 5 potential answers here. Certainly they are designed to be somewhat exclusive of each other, but we can see folks reacting across a lot of different ways. So the way we phrased it here, and if you could start responding to the poll, that would be great. So as a result of the vote last Thursday, what's your initial inclination on asset allocation? So the first option, option A, is staying in the courts, maintaining asset allocation, really waiting to see what happens. B is to really be a contrarian and consider buying assets or rebalancing with the lows, some lows that we've seen in the last few days, and certainly lows that could come up in the coming weeks. And then C through E are various options on reducing investments. The first being in C, just in the UK, the next one inclusive of the entire EU, and the third just risky assets generally. And we have seen since the vote, volatility in markets. We've seen some sell-offs, certainly some currency volatility, and it's truly a worldwide event. And part of the presentation today is talking about what this now means for the future. So if everyone has voted, I'm just going to wait a few seconds to see if we get any more folks into the poll.
And we've now got about 75% of folks that have voted in the poll. And just some interesting stats at this point. For the most part, kind of an overwhelming consensus on kind of the views here. 45% of folks have essentially said stay the course and keep your approach as is. Another 40% have said consider buying assets and rebalancing on the lows if we see some further declines in assets. And then kind of the remainder, 3-4%, considering reductions, but clearly a very small minority of the folks that have voted.
Thanks, Phil, and thank you all for responding. Nice to have that information going in, and nice to see, what we would consider really an important trait of institutional investors is that we try as an industry not to be reactive to markets, but to have long-term views, and then look for opportunities. As about half the group staying the course, about half looking to opportunities to buy low. As I said, I'd like to just give a brief overview and really spend the bulk of the time here hearing from experts at the managers. But thought it made sense to have just an overview. Certainly this has been in the news a lot, so I know a lot of people are on vacation. If this is your first day back, what has happened here is that Britain had a vote, and David Cameron, coming in as the Prime Minister, came in and said, we're going to have a vote on continued membership in the EU. That vote was held last Thursday on June 23rd. There were strong camps on both sides with reasons to either stay or to leave. And generally the thought was going in for many months that staying was going to be the most likely outcome. Some polls were indicating moves towards leave, and some betting markets were indicating moves towards leave. But in fact, going into Thursday, the expectation was to be a close vote, but one that would stay in the EU. In fact, as you know, Great Britain voted to leave the EU, and we posted an interesting graph here that CNN created. I don't know whether it's good to take the red and blue that we use for votes in the U.S. and translate them to the UK here. But in fact, what's very interesting about the vote is while it was a close vote, 52% for leave, it was very concentrated in that England and Wales generally voted to leave, whereas Scotland, Northern Ireland, and importantly London voted to stay or remain. And we find that interesting because of the different views, the different demographics. Certainly London as a financial hub for Europe, seeing the potential for a loss of that role. So those were the results. I thought I'd leave with a couple of polls across Europe, because one of the key questions here that the managers are going to talk about is what this means for broader Europe. So there's certainly implications for the UK, but I think a concern of investors is, does this represent a contagion that will then flow to other referendums around the country? I did want to note that in addition to the poll that we had a few moments ago, we'd also encourage you to ask questions online. There's a box for those of you participating on your computers to ask questions, and we'll be hopefully spending a fair amount of time for questions at the end. So again, back to these polls. So on the following slide, we have the views of the European Union. So how favorable do voters in each of these countries view the EU? And the interesting part here is that the UK, which now voted 52% to leave, was relatively split toward the top of the page, with only Greece and, interestingly, France viewing the EU less favorably than the UK. And so one of the themes going forward will be that there is some likelihood that some of the countries on this page will have leave votes falling upon Britain. And certainly many of them face the same sort of split that we see on this page. You see below, more countries that are more favorable toward the EU, more toward the periphery in the south. And the final page I'd like to go through is a look at a little bit of a different question from the same Pew survey on views. And this was whether individuals in these countries felt that the EU should have a more active role. Now, this is a fairly open-ended question, so we can't parse this out to say, are they saying more stimulus? Are they saying more support for local programs. But it's interesting to see that really every country, every demographic on this page did support a more active role for the EU, although notably the UK was the smallest percentage, with 55% supporting a more active role. So we think this does represent a dichotomy. So a number of countries, voters actually would like to have more autonomy, yet on the other hand, a larger majority of voters would love to see a more active EU. So with that, I'd now like to turn it over to Nanette Jacobson from Wellington to go through her thoughts and their thoughts on these markets.
Great. Thank you so much, Chris, and thank you for NEPC for inviting me and my colleague from Loomis, Sayles, and thank you everyone for joining. So the title of my presentation is the UK from the EU to the ER with a question mark. And I certainly don't mean to make light of a very serious situation, but any levity at all in this confusing times, I think, is welcome. I think, let me just start by saying we're in a very difficult environment, and markets are in the process of trying to figure out whether Brexit will remain a localized event or one that foments uncertainty and weakness and spills over to European growth, European financial markets, and ultimately global growth. And what I'd like to do on the next slide is just give you my key points. First of all, I do think Brexit is a big deal, but it's not a Lehman moment. I don't see this heading to a financial crisis. We're in a highly fluid situation, and what I try to do is consider what we know, what we don't know, and try to position portfolios and give recommendations to our clients with narrower distribution return outcomes. So what we know. We think we have higher confidence in the following things: that we will see a weaker UK in terms of growth, that we will see some spillover to European growth, and that increased political volatility will be a driving theme of markets. And that's because the political volatility that we're seeing, I would consider Brexit more of a symptom than a cause of what we're seeing in markets, because there are common issues across regions that brought the vote to its to the Brexit outcome. Now, what we don't know is the extent of the spillover to Europe, to the US, and to global growth. What's the magnitude of the growth shock and how much contagion? And importantly, we also don't know what the time frame will be. Will this be a one-month event? Will it be several years? Our inclination is to say that the workout of the Brexit will take several years. It's a very complex situation, and a relationships, regulations, financial agreements that need to be worked out, which could take quite a long time. Just to give you an idea of where our growth forecasts are, we've just updated them, and this is coming from our UK and European macroeconomics team. So for 2017, we are forecasting that GDP for the UK will be -1%, so recession, and a drop from our previous forecast of 3 percentage points. I highlight that because that is non-consensus. Most consensus forecasts are a drop of a few tenths of a percentage point. So this is more serious. For Europe, our GDP forecast has also dropped 0.4 of a percentage point, and we are now at 1.1% in GDP for 2017. Most of that is coming from Germany. Germany really has the highest exposure to the UK, and so that's the source of that reduction. But as you see, it's still slow growth, but not a recession in Europe. Okay, the third point is about portfolio positioning. I do feel, contrary to the respondents to our survey, that the increased uncertainty and the difficulty in analyzing political events does support moving portfolios to a more quality-oriented bias. And in that vein, I favor credit over equities. I favor U.S. assets over European and Japanese assets. And I am recommending holding some insurance-type assets like gold and U.S. duration. And I'll go through my reasoning there. And then finally, on the positive side, I don't expect global recession. And I do think, like our listeners, that there will be potential opportunities to add risk when these bouts of volatility from a macro and political standpoint indiscriminately reprice countries or companies that have good fundamentals. And two areas that I would point to are oil-related assets and also in emerging markets, specifically local debt. I think it's interesting that emerging markets have been relatively unscathed in this market sell-off. And that may be telling us something about their relative insulation from the Brexit fears and European breakup fears. If we can turn to the next slide, let's talk a little bit about the politics that are underlying Brexit. So my view is that the discontent that brought us Brexit is slow growth, rising income inequality, job insecurity. People see that as through globalization, and of course immigration was a big part of this vote. And I thought it would be interesting just to look at the demographics of the vote in the UK and draw some parallels to other regions in the world. So if you look at the left-hand chart, you'll see what we're measuring here is the percentage of residents with higher education. And the blue dots represent votes for leave, the yellow dots to votes for remain, and the size of the dots, this is data collected by county in all of the UK. And what you see is that there seems to be a trend that the demographics of the Brexit vote, that really a fairly low percentage of residents who voted leave had a higher education, so less educated. And then on the right-hand side, what we look at is the demographics of age. Here it's more of a cloud of dots, but there is somewhat of a tendency here that the votes for leave were dominated by older people. And of course, without uttering any specific names, we know that some of these themes, education and age, have been themes that are evident in other elections in other regions in the world. And also themes of anti-globalization, anti-immigration. And what we're facing now is a very heavy election season. So on this next slide, we see that there are 8 elections over the next 12 months in Europe, and of course in the EU, in the US, in which some of the same issues as in Brexit will be debated and could result in moves away from centrist parties. And that's why I think political uncertainty is such an important factor in driving markets. Usually we ignore politics as more noise than fact. But right now, we're already looking at global trade having already registered the largest decline since the global financial crisis because of low commodity prices. And so if global trade is already declining and shaving growth from global GDP, and if we move more in the direction of protectionist policy, anti-immigration, anti-global trade, I do think that will be a negative for growth. Now, on the flip side, we've had Spanish elections this weekend that brought some promising results, and perhaps people are considering the economic impacts of Brexit. So that's one data point, but as you can see, we have many more elections to go. Other things that I think are important to watch are currency. And here I have a picture of the U.S. dollar. This is the DXY index, which is weighted by a number of countries, euro being the biggest basket against which the dollar is measured. And you can see that since the Brexit, the dollar has risen about 3% versus this basket of developed countries, the euro, the yen, the British pound, etc. And I think this is really important because if the U.S. dollar continues to rise, it's going to add financial pressures in several ways, 4 ways specifically. Number one, a stronger dollar is a net negative for the U.S. economy. It affects our exports, it makes them more expensive, and there's a translation effect of earnings that are received overseas back into dollars. Number two, a strong dollar generally means lower commodity prices, including oil. And that is going to be a pressure on emerging economies that are big exporters of commodities. If commodity prices are low, that obviously is a negative for EM, as well as not only their commodities exporters, but their currencies. And finally, this seems a little bit more remote, but something to watch. It's first in a long time that we haven't talked about China. And China remains a really big, important theme in global markets. When the dollar rises, that puts pressure on the Chinese currency. And what we've seen already is the PBOC, the central bank in China, has lowered the fixing versus the U.S. dollar quite a bit. It's the lowest level that we've seen, about 6.6 renminbi to the dollar. And if that became disorderly, that could spark capital outflows, which is what we were talking about last August. Now, my view of the dollar is that I expect it to stabilize because I think there are countervailing forces for the dollar. In the direction up is certainly the external forces of a weaker euro, a weaker British pound. But I do think the dollar will stabilize around these levels because we've had a big shift in Fed hiking expectations. And specifically, markets have taken out all Fed expectations of hike for this year. And even though the Fed's expectations of more than 3 hikes in 2017 are part of their projections, I expect the market to shift considerably and to take most interest rate hike expectations out of the market. And so because of those countervailing forces, I do think that the dollar is likely to stabilize at these levels. Now, the other support for U.S. assets is on this slide. And I say U.S. is the real high yielder. What we're looking at here is real yields. So it's nominal yields excluding inflation. Not that there's much inflation, but it does exclude inflation. And we're looking at those 10-year real yields across 4 regions. The U.S. in dark blue, Japan in light blue, Germany in orange, and France in the lighter orange, in yellow. And the point that I want to make here is that we are in a global yield environment in which U.S. Treasuries stack up as a high yielder, amazingly enough, at 1.5%. We at Wellington are seeing clients search for yield intensifying, not only in the U.S. but globally. European and Asian institutional investors are moving into U.S. Treasuries, and they're moving into credit at a more intensified pace. So I think that for those who are concerned about higher interest rates in the States and the fact that interest rates may not reflect the fundamentals in the U.S., which I think are clearly better than in the rest of the world, this should be an important signal that higher U.S. rates relative to the rest of the world is an important driver of capital flows into U.S. assets and into U.S. Treasury yields. And therefore, I am, from a duration perspective, I am recommending being neutral U.S. duration, but underweight in other developed countries. Okay, let's talk more about implementation. So what are the opportunities and why my recommendation to overweight credit relative to equities? What I've done here, and I apologize, it's a fairly busy chart, but I'll focus your attention on the important numbers. On the left-hand side, I'm showing a snapshot of credit spreads. They're in option-adjusted spread terms along the first row in a variety of credit sectors: high yield, investment-grade corporates, European investment-grade corporates, and the ENVI, which is emerging markets in the U.S. dollar-denominated debt markets. On the right-hand side, I have 12-month forward PE ratios of the major equity markets, and these are the MSCI U.S., Europe, Japan, and emerging markets. And the green is highlighting those sectors that are historically cheap over the past 5 years and the past 15 years, and those that are highlighted in pink or red are expensive versus that same time period. And so what to look at is, starting with credit, we can see that 5-year percentiles, which means, let's go through a quick example, U.S. high yield at the 80th percentile means that spreads have been wider only 20% of their 5-year history. 63 percentile on the 15-year mark means that 27% of the time spreads have been cheaper over a 15-year history. But bottom line is that credit spreads across the board are cheaper than their median, and sometimes considerably cheaper in emerging markets and in U.S. high yield specifically. On the right-hand side, we see the 12-month forward PEs. And on that basis, you can see that most markets, they certainly have corrected. Particularly Europe is now a little bit cheaper. Japan is really the only region that's flashing very cheap on an earnings perspective. And because earnings have collapsed in EM, they're actually showing up relatively expensive. So compared to credit, I think that credit is actually has better valuations relative to equities. You may question about credit fundamentals, and certainly debt has been increasing. $1 trillion, more than $1 trillion of debt has been raised in the past few years, and much of that's gone to stock repurchases, dividends, and M&A. But if you exclude healthcare and energy, you actually find that debt and leverage ratios are healthy, and interest rate coverage, because interest rates have been so low, are also quite healthy. And then as far as equities go, within equities, as I've said, I want to take a quality bent, and that bent translates into being more overweighted in the U.S. than Europe and Japan and EM. Despite the fact that valuations are on the expensive side, I do believe that that premium will persist. All right, and to wrap up on my last slide, I think that what we're dealing with is probably a multi-month, if not multi-year period of uncertainty. And that backdrop, I believe, supports an increase in portfolio safety. The way to do that is to stick to quality by favoring credit over equities and U.S. over other regions. I even think that owning some gold as a disaster hedge is appropriate. The third point is that I believe investors should look for opportunities, and that this is in case we have a surprise positive shock. Then I want to be looking at stronger fundamentals that will overwhelm the macro and political events that may discount a lot of good companies and good sectors. The two areas I recommend are oil-related assets. Our forecast for oil this year is $50. In 2017, our forecast is $65 a barrel, and 2018 is $70 a barrel. So I continue to like, within risk assets, oil-related assets, and also emerging markets local debt, which I believe will benefit from its relative insulation from Western politics and developed country politics, and also will benefit because of the very attractive carry in local debt markets. And finally, as we're all trying to figure out what's going on, this is what I'm going to be watching. I think currencies are very important to watch. Financial stocks, banks in the European area, as well as the U.S. and the UK. And finally, financial conditions. And financial conditions means how are markets performing? What are markets doing here? Are stocks down? Are spreads wider? Because that can ultimately feed into the real economy. So I will stop there, and we'll turn it over to Laura.
Yeah, and just a brief note. Thank you, Nanette. If you're on your computer and you have questions for what Nanette has just presented, please submit them. We'll be doing a Q&A at the end of the webinar. With that, I would like to turn it over to Laura Sarlo to talk about her views and Loomis's views on Brexit.
Thank you, Chris, and thank you for setting the stage so well with so much background information on leading up to the vote. And Nanette, thank you. I think we have a lot of maybe common themes, so maybe I'll kind of focus on comparing and contrasting some areas where we have some different ideas. So the Brexit drama that we're all living through certainly has fallout for a number of different dimensions. In terms of the economic fallout, we expect that the UK economy will head into recession in the second half of this year. We had already seen pretty meaningful slowing in some of the high-frequency indicators in the weeks and months right ahead of the vote. This should create scope for the Bank of England to further accommodate the slowdown with additional easing of monetary policy, and it certainly means that any fiscal consolidation that had been proposed in the UK will be pushed out further. That outlook for the UK would support high-quality fixed income there, supports the trend of global lower yields for longer, and the curve flattening that we've seen across so many countries in recent weeks and months. Nanette highlighted that there's a tremendous amount of things that need to be figured out in the UK. This is a multi-year process. I would remind everyone that the last time Europe needed to go through a major negotiation was the Treaty of Lisbon, and it took them 8 years to get through it. So although there's great attention to the idea that Article 50, whether it is invoked or is not invoked in this whole UK process, that Article 50 has this 2-year time frame attached to it. That 2-year time frame is it's just a number, and it may turn out to not be at all close to the right number. There's a tremendous amount of domestic political upheaval, which I'm sure everyone is watching. It's unprecedented to have this kind of meltdown in the Conservative Party and the Labour Party at the same time in the UK. So that's going to take weeks to settle out, and it looks like perhaps we will have a new Conservative leader the first week of September, which will give us hopefully a UK government, but there then is the potential for fresh general elections, and so things are quite messy. So we need some clarity on UK domestic politics before we begin to really think about how the negotiation between Europe and the UK will look over the coming years. And again, that may be a multi-year period. In terms of the market fallout, Nanette mentioned systemic risk and Lehman, and that word has such a charge to it. I don't expect that this is a systemic event for world markets as it stands at this moment. So central bank liquidity is certainly ample globally. The central banks have all been very quick to remind everyone that it is ample and that they would provide additional liquidity as needed. Certainly the swap lines that are in place now compared to the global financial crisis make funding in dollars globally much easier for everyone. So I don't think we have that stress presently. What can be an important change to that view would be if we do see the crisis spread. And Nanette laid out the elections that are coming in parts of Europe. the political risk that exists across developed economies, I would say, is a function of lackluster economic growth post-crisis. When people don't feel that the pie is growing, the blame game begins, and we have seen that time and again in different countries, and each additional election cycle across economies gets more and more dangerous. So that is just a fact, and I believe in my core that a little bit of growth would go a long way to easing many of these political stresses, and so that is really critical in my mind. And with central bank policies pretty fully deployed in a lot of economies, how do you generate that growth to allay some of these stresses? And that is why in a lot of economies you see this, this discussion about fiscal policy and the potential to deploy fiscal policy. And I mentioned I don't think that the UK will tighten fiscal policy as they had planned. And you know, we've seen the Juncker plan from the Euro area as a quasi-fiscal policy, and we've seen some countries in the Euro area trying to make use of the flexibility in the budget rules to allow some support for economic growth from the fiscal authorities. So that is, to my mind, the key question is getting nominal growth going across developed economies in order to ease some of these political pressures. And so that is where the downside lies for global risk assets, would be that nominal growth struggles or gets worse, or the political risks continue to mount across the different countries in coming months. So the Italian election, referendum rather, on Renzi's electoral reform in October is the next key bit. Nanette mentioned the Spanish election this past weekend, but October will certainly be a key bit. I think if we have all the ingredients are there to turn this into a systemic crisis for Europe, but at this point it is localized, as Nanette described. The risk would be that we have several other things go wrong while this is still a muddy process, and that can change how important it is in terms of global impact and global risk assets. I'd mentioned that in terms of growth numbers, I think maybe, Nanette, we can take this offline, but I think maybe we have a little different view on the UK outlook for 2017. So, you know, we had incorporated Brexit into our base case view for the economies, and so our view is that there will be a diminishing impact as we go through 2017 from Brexit. And so while we do have a second half recession in our UK forecast, we see growth improving as the year wears on through 2017, and so we have a small positive for UK growth for next year. And I'd say we're broadly in line with your expectations for the Euro area economy next year, that it is it does shave something off growth, but that it is not too bad, certainly compared to trend Euro area or potential Euro area growth of maybe 1 to 1.25%. I'd like to just highlight maybe some market implications. You know, we have seen the UK sovereign be downgraded. We would expect that the negative ratings pressure to remain on the UK, and there has been a great focus on the ratings for the banks and the stress on the banks. If you have not looked at charts of UK bank stocks, I would advise that you not look at them. They are quite appalling. We've seen tremendous downward revisions to future earnings. There's a little chart in here, sorry, on slide 5 of, you know, one of the things that we've been talking so much this year about is the negative interest rate implications on the banking system. And this is a theme that has been in place for some time, but has really ramped up in the market's mind with the Bank of Japan's decision to go to negative rates in January of this year. And so that stress on future profitability for the financial system is still there, and it will be with us. I think the Brexit decision has only amplified concerns that, with the Bank of England then likely to cut, could the ECB cut further from their already negative rates, and would that add to further stress on net interest margins across the financial system? However, I would say the banking system globally, and particularly, well, I should say really in developed markets, is much stronger than it was coming out of the global financial crisis. Banks are better capitalized, liquidity is very ample, and the system in Europe, while deleveraging, is slowly healing. And so I think the bank, and on the credit side more so than on the equity side, given the challenges to future profitability, but I think there's opportunity there. And again, the capital flow to the U.S., I liked Nanette's chart of the U.S. as a high yielder, and it's true. We do see across European markets capital outflows on the fixed income side, the search for yield, moving further out the maturity spectrum. It does favor the U.S. I think in an environment where Brexit is going to be a constant background discussion, hopefully it will be less acute than it is at the moment as we go forward over the next few months, that as it continues to churn along, provided we can make sure that nothing else is going wrong at the moment. So I'm assuming that that we kind of have a fairly benign global outlook with respect to the U.S. and with respect to China. That would set up an environment for EM assets and carry-related assets to perform well. And so that is something to consider over the next few months, that collection of yield and carry will be a theme, provided we don't have any large disruption from where we stand today. So I think maybe I'll stop there, and I'm really excited to hear questions.
Okay. This is your opportunity. We've got looks to be a fairly long list of questions, so maybe that's a good way to spend the rest of the hour. So Phil, what's a question that our participants have asked?
Thanks, Chris. Yeah, we've received quite a few questions, and unfortunately I don't think we'll quite have the time to get to all of them. But feel free to continue to submit as we go through Q&A. And maybe just to start, lead off with Laura. Just from your firm's view and your view, what's the prospect of or probability of the referendum being ignored in the UK and possibly they remain in the European Union?
Yeah, that is possible. That's certainly a common question, I'm sure, that Nanette has gotten over the last few days as well. It is possible. There is a history across Europe of referenda being redone, as it were, across several countries over time. Usually those revotes tend to happen within around 18 months. So if it were to happen, it would be maybe along the 1 to 2 year time frame. There are a number of things. Well, right now everything is quite fresh and everyone's feelings are hurt and it's very acute. So there would need to be some cooling and some scope for face saving on all sides before we were able to get to something like that. And someone would need to be in charge of the UK, which at the moment we don't have. So that will need to be, that's an issue perhaps for after September when we have a new UK government, and provided we're not in the midst then of a general election. Cameron had gone to Europe to negotiate the terms of the package that he would take to the population in this vote, and he walked away in February with a rather weak hand, particularly around the issue of immigration, which Nanette raised, which has been at the top of voters' minds across European economies and across the UK. And so Cameron didn't get a very good deal to run with, and so I think that has been part of the challenge. There's been some speculation that he could go back. There could be a better deal sorted out. Boris Johnson has at times indicated a potential idea that he could negotiate a better deal with Europe. The attitude to Europe at this point, and again, fresh hurt feelings, would be, please see yourselves out quickly. But obviously, it is a large economy, and it does have the potential to create a larger existential question for Europe. So I think the scope for that is there. It's not our baseline view, but it is not a non-zero probability, but it will be more months before we can assess it.
And Nanette, maybe as a follow-up to that, thinking about the possible ripple effects, pro and cons of the recent referendum, and how you think about that from a portfolio positioning, which you discussed a bit, but also relative to maybe some prior crises that we've seen, whether it's 2008, financial crisis in Asia in the late 90s. How does this compare in your mind?
Yeah. So those are good questions. Excuse me. Let me just say, just as a follow-up to Laura's comments and her thoughtful answer, I think in terms of the second referendum, it would be very difficult for the new leader to not recognize the vote of the people and to not at least negotiate from the starting point of the outcome of Brexit. So, and so I think, and our economists think, that the starting point has to be some sort of exit solution. That said, this is a very unprecedented time, and so anything could happen, but that also would not be our base case. In terms of the ripple effect, I think the main discussion we're having at Wellington is about the ripple effect to Europe and reigniting the EU breakup question, which was so prevalent and so dominated post-crisis in 2010, 2011, 2012, and could that happen? And again, it's not our base case, but I do think we are really putting it on asset owners' radar screen that you've already had a rise of anti-centrist parties in many countries, Austria, Hungary, Poland, I mean the list goes on. And therefore, these elections that are coming up that are driven by anti-immigration, anti-globalization, frustration with income stagnation, frustration with slow, sluggish growth. These are themes that are quite prevalent across Europe, and therefore in a heavy election season you could see real change in leadership. And so those are the conditions where we feel you could have the whole issue of EU breakup risk come to the fore again. And as far as financial crisis goes, what's different this time from other financial crises, I do think that it's the reason that I focused on the financial system as a thing to watch, because in past crises, the 2008 crisis was so much about the financial system being the central nervous system of the global economy. And with that, highly leveraged positions. So at that time, as we all know, banks had, were 40, 50 times leveraged. And the one thing that we can say, and I suspect Laura would agree, is, and she already alluded to this, is that the banking system is in much healthier shape than it was then because of the capital that's been raised, lower leverage, and all the other regulation, which we can argue about if it's stunted growth, but it has made at least the banking system healthier.
I would just add on to that, if I can, that if you, with all the ingredients there to go back to that EU breakup question, as we did in 2010, 2011, 2012. If the market sinks its teeth into that topic, they're going to look around and recognize that the ECB, all the things that they wished for as crisis solutions then, have now been done. So what then? And that is a very challenging question. And relative to that bit of crisis, Chancellor Merkel, as the leader of Europe, her position is meaningfully weaker domestically and abroad today compared to that.
And kind of moving off that, when we think about kind of the what then, for you, Laura, when we think about, is there a proactive or some sort of significant political response that you think would be beneficial, whether it's from the EU or Germany, that would give some support to the markets?
Yeah, well, that's kind of a very interesting question. I think when we maybe take an outside perspective and think from a capital markets lens, the solutions tend to be more Europe, imagining a greater federal system, a stronger centralized EU budget, a finance ministry for the Eurozone, something like a unified issuance Euro bonds, which has been talked about so many times, right? All of these solutions that seem to make sense from our numbers perspective and economic logic may not be politically feasible, given that so many pieces of the European populations want less Europe, not more Europe. And so I think that would be, if the market were to get to that level of concern and recognize that the solutions that make sense on paper are not going to be possible in political space, that is where the real risk would lie.
Yeah, I would just add to that the European Union has been an incomplete experiment. You've had a common currency, but you haven't had consolidation of the banking system or the fiscal system. And therefore, by having it partly done, but not all done, you've seen stress on weaker economies, you've seen bailouts, and these are all responses to a system that really is not conducive to a growing continent. So I do think that the ECB, I mean, in terms of generating growth or helping markets at least, the ECB does have some more firepower. If you look at their balance sheets as a percentage of GDP, there's still capacity to expand their asset purchases. The EU, I mean, the commitment to the EU, I do think, is very strong and really goes back to a response to, world wars, frankly. And so I think the commitment is there, and whatever it takes, it may not be as potent as it has been, but I do think that it will continue to be the words that we hear, and that the ECB will do more. Whether they, and they could lower rates further into negative territory. So I do think that there probably is some room, more scope for more central bank action. In terms of, the real thing that has to happen is structural reform. And we saw in Spain, and this may be why the Spanish elections came out as they did, Spanish has been the fastest growing country in Europe. And partly that's been because they've taken their medicine, which is to cut debt, to liberalize labor markets. And that is really the medicine that a lot of countries need. So I think that if structural reform like that were to spread, that could be a good thing. The problem is, and the difficulty is, that the political difficulty of doing that now is so high, because it does mean essentially more austerity, which is what all the countries are fighting against.
Maybe we'll take a pivot and talk a little bit about portfolio positioning overall. And I'll throw this to you, Chris. Both Nanette and Laura mentioned and discussed, the benefits of kind of a safe haven U.S. duration exposure relative to global developed markets. Any thoughts in your mind of, what's the best positioning of how you achieve some of that duration exposure in today's market?
Sure. We've spoken about this for a while, that duration is something that we think most institutional investors should have because of the properties it has. So having bonds generally and their rate exposure in times like this, in a crisis. So it's interesting that after a third of a century of lower rates, each week it seems there's an article that says that rates can't go lower, and then things like Brexit happen and they go lower. So the 10-year Treasury now is close to the lowest it's ever been. And the lowest it's ever been was actually back in 2012 during the Brexit concerns, not during 2008. So it seems like each time that we face one of these challenges in the markets, while they don't seem to be as systemic as the financial crisis, both through central bank action and just fear that happens when there's concern in the markets, we keep driving these rates lower. Our view has been consistently that to get that rates exposure, it's a real challenge to accept the bar cap aggregate index as your bond exposure, when as an aggregate it's mostly Treasury and agency bonds, and it's also got a duration that's going to bounce around, but it's not giving you a lot of rates exposure. And if you really look at institutional investors, they've reduced their core bond allocations over time. So they've actually reduced their protection that they have through rates. So one of the things that we recently presented at our client conference was this idea of having fixed income barbells. So barbelling Treasury exposure with credit exposure, but also barbelling exposure to more active bond management with low duration or variable duration with a targeted duration in the longer part of the curve. This is certainly something that many of our corporate clients have done in the context of liability-driven investment and better matching their liabilities. But we actually think having some of that exposure that does well in weeks like this is an important part of any diversified asset allocation.
And if we expand beyond kind of fixed income and think about emerging markets, and I'll throw this to you first, Nanette. When we think about some of the recent volatility in developed markets, is that taking on a much more emerging market-like profile? And does that change your relative views of the attractiveness of maybe local equity markets, local currency, or even emerging market credit spreads?
All interesting questions, Phil, and I think I have a couple of reactions. One is this political theme that we've talked about that is overwhelming developed countries about frustration and moving to more populist or non-centrist parties is actually quite different in much of the emerging markets. In fact, recent elections have brought more orthodoxy policies and more centrist because they've been through this before. They've gone through their populist elections and decided it really wasn't so great. So, and I'm talking now about Brazil is really the largest example of that. Argentina, both countries are really coming to the conclusion that they want a different kind of policy than a populist policy because it hasn't served them well economically. So I think that may be some of the reason why emerging markets have held up relatively well. I still think that I would caution investors that emerging markets are still, though, a high risk, high beta asset class. And if global growth declines, emerging markets are very dependent on global growth. So that's one thing. The second thing is, when I thought about emerging markets equities versus emerging markets debt, I do think that emerging markets have undergone a huge correction already. It's been over the last 3 to 5 years. Their currency has declined 30 to 50%. And so their whole, because of their flexible currency regimes, their economies have adjusted. And so their current accounts, which are exports minus imports, are now in balance, whereas they had been in deficit. What does this mean? It means to me that probably, if the dollar does not strengthen much from here, we could see some stability in EM currencies. And again, from the carry perspective, I like local rates as opposed to the equities, because also in this highly volatile environment, a vote for volatility, emerging markets local debt is half the volatility of emerging markets equity. So if I'm going to take emerging markets exposure, I'd rather do it in the fixed income markets.
Laura, any thoughts?
Sure. I'd say on EM, to Nanette's point about the currency moves we've seen over the last 3 to 5 years, right? We've got a major structural change happening in the Chinese economy, which has had these repercussions across commodity markets and has been, an enormous impact on emerging economies. And they have been in a terrible part of the credit cycle. And now, Nanette talked about some of the political changes, but there's a question about EM finding a new growth model for how they compete in the world economy over the next 10 to 15 years and moving into a better part of their credit cycle. And so, but I think that requires a fair amount of due diligence by investors about each economy in EM that they're investing in, credit differentiation among EM, and depending on how one defines EM, which is always an interesting question, right? But I would highlight that the economies of emerging Europe obviously have a closer tie to whatever is going on in Western Europe, and potential, for a slowing of some slowing of German growth compared to some of the other parts of EM. They are all leveraged to global growth. So I think it's a matter of credit differentiation. To Chris's point about short duration bonds potentially as a nice way to pick up yield, offsetting, some of EM can not just corporate credit, but EM can be part of that equation as well.
Great. And I wish we had time to get to everyone's questions, but I think folks wouldn't want to have another 2 hours to discuss.
And if this just whetted your appetite, there are bound to be Brexit webinars every day for the next 2 weeks. I want to take the opportunity to again thank our panelists for an engaging discussion and for some similar views and some different views. I think that's always very helpful. I want to thank everyone who participated, and if you didn't get your questions answered, by all means, please reach out to your consultants, and we have a lot of materials, and we'll continue to have more information as we go along with this volatility that came from an unexpected vote last Thursday. So with that, I'd like to conclude the webinar and thank everyone for their participation.